Good day, ladies and gentlemen. In this video, I'm going to be teaching you a trading system that can change your life completely. This trading system can actually, turn your trading game around if you take it seriously, okay? So this is basically for the serious folks, okay? All right, because I said serious because once you're done, learning what I'm about to teach you, I expect you to actually go back to the charts, back test and master what you've been taught. It's not just by watching the videos. You need to be able to go back test and master it, okay? That's what makes you a serious Forex trader, okay? So what I'll be teaching you is called CRT, okay? CRT. And it's just a mnemonic or a short form for candle range theory, okay? So this is a candle range theory, and the thing is, one thing I've come to realize is that a lot of traders that offer educative content on the internet, they make this CRT look very, very complex. It is not complex. I'm going to break it down in the simplest form so that you too can, spot it easily, all right, and be able to take advantage of it in order to make profitable trades. That's my aim. I'll make it very, very easy for you. Okay, so what you simply need for this candle range theory is just two things. Okay, once you can spot these two things, you are good to go. So I'm going to be using this this horizontal line to mark out the high and this horizontal line to mark out the low. Then I'm going to draw some diagrams in between. So just follow me. Okay, so let's say you have a candle whose high is that horizontal line up there, like this. Okay, and you've marked out the high and the low of this candle. I hope you understand what I'm saying. This is the high and this is the low of the candle. Now, just this is not enough to, kick off the CRT model. You need the second candle to either wick above this first candle's high, or wick below this first candle's low, and then close inside the range. Look at this next diagram I'm going to draw. The next candle should either wick above, like this. You can see that the wick is above, and then it has to close within the range. Once you have it like this, your CRT model has kicked off. So this is the first option. Second option, it should wick below and close back within the range, like this. Okay, like this. So once you have any of these two conditions, your CRT has already started. Okay, so the idea is that since the liquidity at the top of this candle has been taken by this second candle, the next draw of liquidity is going to be the low of this candle. So we now have a bias that price is going to be pushing downwards. A key a key knowledge that helps Forex traders in making profitable trades is knowing where price is going to. Once you know where price is going to, you have already done 50% of the job. You've done 50% of the task you need to do as a Forex trader. Once you know where price is going to, the remaining 50% is for you to now have an entry model which you can use to jump on the train and move in the direction of price. Very simple, nothing complex. So in the second scenario, whereby price wicks the low and then comes up to close within the range, that tells you that the next draw on liquidity is for price to move up and clear this high. Okay, so we have a bullish bias. All right, so basically that's just what the CRT is all about. So now that you have understood the bias aspect, the next thing you need to understand is how you are going to jump on, the moving train. How are you going to enter to move in the direction you have already predicted? Now, all you need, if the situation is in the first case, that's whereby the high was wicked and then price closed within the range. Now you know the next draw on liquidity is downward, so price is moving to the low. The very first bearish fair value gap that forms on a lower time frame, which can be 5 minutes. If I want to trade this model, I usually use 1 hour. Right now I'm on the 1 hour time frame. So you need two time frames actually. One is going to be your higher time frame, where you kick off your CRT model arrangements. Understand? So that's for the higher time frame. Then the lower time frame is where you go and jump on the train to move in the direction of price. That's where you frame your entry model. Your entry is on your lower time frame, while the setup itself, where you're going to see these first two candles, is going to be on your higher time frame. So you can use 1 hour as your higher time frame, then 5 minutes as your lower time frame, or you can use 4 hours as your higher time frame, then 15 minutes as your lower time frame. Or you can use daily. Some people use daily and 15 minutes, or daily and 1 hour. It all depends on what you want to do. It depends on whether you are a scalper, a day trader, a swing trader. It all depends. This works on all time frame. Remember that price is fractal, meaning whatever happens between a combination of time frames can happen in a combination of other time frames also. Okay, so basically, let me go straight to the examples so I don't take much time. So like I said, when you go to your lower time frame, if your bias is bearish, the very first bearish fair value gap you see, you look for an order block that formed that fair value gap. You can enter on that order block, okay? Because most times price could go past the fair value gap to tap the order block before pushing. I would have just said you should go with the fair value gap itself, but in my experience, most times price goes past the fair value gap to tap on an order block. So you can just focus on the order blocks, okay? So first fair value gap that forms in your direction, the order block that formed it, that's where you're entering your trade. Where are you going to be taking your profit? The next draw on liquidity, which is either going to be a high or low. Okay, so I have 2 examples for you. Without further ado, I want to go straight to my examples so I don't waste much time. Okay, so I'm on the 1 hour time frame. I'll be combining 1 hour and 5 minutes. So on the 1 hour time frame, look at this bearish candle right here. Okay, so I'll mark out the high and the low of that candle. There's nothing special about me choosing that candle. I chose that candle because I could see that the next candle wicked below the low. So it's a good example. That's why I chose it. So if I happen to be doing this on in real time, if this has to be live, once I mark out the high and the low of the candle, and the next candle did not wick below or above it, that candle is invalidated. Okay, so I can't use it. I have to mark out the high and the low of the next candle. Okay, so I keep doing like that until I arrive at a candle that gives me what I want. So this combination gives me what I want. That's why I'm using it. If you check, you would see that this is the high of the candle, this is the low of the candle. Now the next candle did something significant. It wicked below the low, then came back to close inside the range. So that tells me automatically that my next draw on liquidity is up here. So I now know that price is moving up to clear the liquidity above this. So I know where price is going to. So what am I going to do? Let me place the vertical line here. I want to place a vertical line on this. Sorry, because I clicked on the wrong line. Delete. I need a vertical line. Where is it? Okay, so I'll place it here. The reason why I'm doing this, I want to know exactly where to stop when I go to the lower time frame. So I'll quickly switch to the 5 minute time frame, which is my entry time frame. Okay, where's our vertical line? Okay, all right. So is this 5 minutes? Let me see. No, this 15 minutes. I need 5 minutes. Okay, so where's my vertical line? All right, it's right here. Okay, so now I have my vertical line, and what do you see playing out right here? What do you see here? Look at this. This is a fair value gap, right? So this fair value gap is a bullish fair value gap. Remember, our bias is bullish, okay? So this is a bullish fair value gap, which is in our direction. So now that we have come to the lower time frame, look at the other block, which is this bearish candle here that formed the bullish fair value gap. That's what we're going to be using to frame our entry. So I'm going to be marking out the boundary of the other block. Mark out the boundary of the other block. Okay. So the boundary of the other block has been marked out. I'll simply wait for price to come back there and tap me in. Stop loss is going to be a few pips below that boundary, and your TP, you know where your TP should be. It's going to be at the high of your big 1 hour candle. So you can see the way price pushed aggressively in our direction and would have, smashed our TP right here. Very, very simple. Please, if you're getting any value from this video, subscribe to the channel if you're a new viewer. That's the only thing that encourages me to keep giving you this secret here day in, day out. Okay, so I believe you understand this explanation. Let me give you my second example. If you don't understand anything that I've said, any part of what I've said, please, you can ask a question in the comment section. I'll do my best to answer you. So let's go back to the 1 hour time frame, and this happens to be my second example right here. Okay, so I'll mark out the boundary of that candle. Why did I choose that candle? I could see that it's actually played out the way I want it in terms of the two candle system. Okay, so I've marked out the boundary of that candle, and you can see what happened with the second candle after it. It wicked above the eye and then closed below. So I chose this example because it's like the opposite of the other example. I wanted to give you a buy scenario and a sell scenario. So I've explained the buy scenario. Now this is for the sell scenario. Okay, so what I simply do, I need a vertical line. I'm placing this vertical line so I can know where to stop when I go to the lower time frame. If it's in real time and it's playing out live, I don't need to place any vertical line. I'll just go down and look at the current price action in the lower time frame. I already know I'm looking for another block. Okay, so now let's go to the lower time frame, 5 minutes. So I'm simply looking for my first bearish fair value gap and the other block that formed it. That's what's okay. So this is my what's it called? This is my lower time frame now, and this is the 5 minutes 5 minutes time frame. So let me delete this vertical line right here. I want to delete this vertical line. Okay, so where is our first fair value gap now? Okay, look at this. This is a fair value gap right here. Okay, so you have a fair value gap there. This is the other block that formed that fair value gap. Okay, so you can simply mark out the high and the low of that candle, which is going to stand as your order block. And what do you see playing out? Price came back into the order block with this bearish candle that pushed upwards into that order block, and then displaced in the downwards direction. It displays in the downwards direction, hitting the TP. Okay, so basically that's just how simple CRT is. That's candle range theory. Very, very simple. A lot of people try to complicate it. All you just need to do is to be able to understand what the bias is and frame an entry model to enter the market with it. Alright, so if you got any value from this video, please subscribe to the channel and turn on the notification bell. I'll see you in the next video. Thanks for watching.